Have you ever wondered what shares and debentures are? Today, we'll unravel these financial terms for you. Welcome to the RBScom channel. Imagine a pie. When a company is formed, this pie is divided into multiple slices, each representing a share. When you purchase a share, you essentially buy a slice of this pie, making you a part owner of the company. This ownership gives you a claim on the company's assets and earnings. On the other hand, debentures are like IOU notes issued by a company. When a company issues a debenture, it's basically borrowing money from you with a promise to pay it back at a future date, with interest. It's a debt instrument that doesn't give you ownership, but gives you a higher claim on earnings than shareholders in case of liquidation. So, in a nutshell, shares are about ownership and debentures are about debt. Now that we've covered the basics, let's dive deeper into the world of shares. Issue of shares. Companies issue shares to raise capital. But how does the process work? Let's dive right in, shall we? When a company decides to raise capital by issuing shares, it's making the decision to go public. This decision isn't taken lightly because it involves a lot of planning, preparation, and not to mention legal work. So, what next? Enter the investment banks. These financial institutions play an essential role in the process. They act as intermediaries between the company and the public. It's their job to make sure that the shares are sold and the company gets its needed capital. Now, the next step is interesting. Pricing the shares. This is where the company and the investment bank need to put their thinking caps on. They need to set a price that's not too high to discourage investors, but not too low to undervalue the company. It's a delicate balancing act. They consider factors like the company's financial health, market conditions, and the company's future prospects. Once the shares are priced, it's showtime. The shares are sold to the public in an event known as an initial public offering, or IPO for short. This is when you and I can buy shares and become part owners of the company. But it's not a free-for-all. Large institutional investors like pension funds and mutual funds often get the first dibs. Then the remaining shares are made available to individual investors like us. So, there you have it. That's how a company goes from private to public, issuing shares to raise capital. It's a journey that involves careful planning, strategic pricing, and finally, selling the shares to the public. And here's a fun fact for you. Did you know that the largest IPO in history was by Saudi Aramco, the Saudi Arabian oil company, which raised a staggering $205.6 billion in December 2019? So when you buy a share, you're essentially buying a piece of the company. Now what happens if you fail to pay for your shares? Stay tuned to find out. Forfeiture of shares is a serious matter. It happens when a shareholder fails to meet their obligation to pay for the shares they have bought. Now, you might be wondering what this process looks like. Well, it typically begins with a notice of call. This is a formal request by the company for the shareholder to pay the outstanding amount for their shares. It's not unlike a friendly nudge, a reminder to fulfill their end of the bargain. But if the shareholder ignores this call or is unable to pay, the company can choose to take a more drastic step, the forfeiture of shares. When shares are forfeited, they are essentially repossessed by the company. The shareholder, who was once a part owner of the company, loses their rights to those shares. This means they no longer have a claim to the company's assets or profits related to those specific shares. But what does this mean for the company? Forfeiture of shares can be a double-edged sword. On one hand, it allows the company to reclaim unpaid capital. It's a form of protection, a way for the company to ensure it gets the funds it was promised. On the other hand, forfeiture can also harm the company's reputation. It sends a signal to the market that the company may be struggling to collect on its issued shares, which could discourage potential investors. It's also important to note that the process of forfeiture is strictly regulated by company law to ensure fairness. For instance, the company must provide adequate notice to the shareholder and give them an opportunity to pay before proceeding with forfeiture. In essence, forfeiture of shares is a last resort, a step taken when all other avenues to collect the unpaid amount have been exhausted. It's a serious matter with significant consequences for both the shareholder and the company. Forfeiture of shares is not a situation any shareholder wants to be in. But what if you own preference shares? What happens when they are redeemed? Preference shares come with a unique feature. They can be redeemed or bought back by the company. Now, let's break down what this means. Preference shares are a type of share that gives the holder the right to a fixed dividend before any dividends are paid to ordinary shareholders. These shares are so named because they have preference over ordinary shares when it comes to dividend payments, and also in the case of company liquidation. Now, on to the redemption part. When a company redeems preference shares, it essentially means that the company is buying back these shares from the shareholders. This process involves a series of steps. First, the company announces its intention to redeem the preference shares. This is usually done through a notice to the shareholders, specifying the number of shares to be redeemed and the redemption date. Next, the company sets aside the necessary funds for redemption. This is typically done by creating a capital redemption reserve out of profits which are free for distribution as dividends. On the redemption date, the company pays the shareholders the nominal value of the shares plus any premium, if applicable. After payment, these shares are effectively cancelled and cannot be reissued as preference shares again. But why would a company choose to redeem preference shares, you might ask? Well, there are a few reasons. For one, it could be a strategic move to reduce the fixed financial obligation of dividend payments. Alternatively, the company might want to alter its capital structure or take advantage of favorable market conditions. On the flip side, for shareholders, redemption of preference shares means they get back their investment along with any accrued dividends. This can be particularly attractive if the market value of these shares has dipped below their nominal value. So redemption is a way for the company to return the investor's capital. But how are shares allotted in the first place? When a company issues shares, it may not have enough for every interested investor. That's where pro rata allotment comes in. Pro rata allotment of shares is a method used by companies to distribute shares among investors when the demand exceeds the supply. This approach ensures that shares are allocated in a fair and equitable manner. So let's dive into how it works. Imagine a company that's decided to issue 100,000 shares, but there's a twist. The interest is overwhelming, and applications have come in for 200,000 shares. Now, the company can't just create more shares to meet the demand, so it has to figure out a way to distribute the available shares fairly. Enter pro rata allotment. The term pro rata is Latin for in proportion. So a pro rata allotment of shares means that each investor gets a proportion of the shares they applied for based on the total number of shares available. In our example, the company would calculate the pro rata allotment by dividing the number of shares available, 100,000, by the total number of shares applied for, 200,000. The result is a pro rata allotment ratio of 1/2. So if an investor applied for 1,000 shares, they would receive half of that, or 500 shares. That's the essence of pro rata allotment. Everyone gets a piece of the pie, just not necessarily the size they asked for. But why is this method used? Well, it's all about fairness. Pro rata allotment ensures that all investors, regardless of the size of their application, have an equal opportunity to participate in the share offering. It prevents larger investors from monopolizing the shares and gives smaller investors a chance to get involved. So, there you have it. Pro rata allotment of shares is a simple, fair, and effective method for distributing shares when demand outstrips supply. With pro rata allotment, every investor gets a fair share. Now let's summarize what we've learned today. We've covered a lot of ground today, from the basics of shares and debentures to the intricate process of share allotment. We started our journey by understanding what shares and debentures are, the fundamental building blocks of any company's financial structure. We then delved into the issue of shares, a process that allows companies to raise capital and investors to gain ownership. From there, we explored the forfeiture of shares, a consequence faced by shareholders who fail to meet their obligations. We also examined the redemption of preference shares, a unique feature that allows companies to buy back shares under specific circumstances. Lastly, we looked at the pro rata allotment of shares, a method of distributing shares proportionately according to the amount applied for by the investors. Remember, understanding these concepts is key to navigating the world of finance. Thank you for watching the video. Until next time, keep learning and stay curious.